Think of it like this. You're one of the members of the selection committee of a cricket team for your state. लेकिन आपको बैट पकड़ना नहीं आता है, बॉल 2 टप्पे पे बैट्समैन तक जाता है, लेकिन आप सेटिंग मार के बैठ गए सिलेक्शन कमेटी पे, क्या खाक चुनोगे आप प्लेयर्स? The mutual fund industry doesn't pose such a challenge. All you need to do is some simple things, some simple steps, and spare a small amount of time. If you understand these 6 key parameters that I'm going to discuss in this video, you can very well find a good mutual fund for your portfolio. Just like I always say, investing is tricky. Every step you take in the financial world is a challenge. And with those challenges comes the next big opportunity. This video will give you an insight for sure, but the next video I post can bring you that next big opportunity. So like this video and subscribe this channel right away. You wouldn't want to miss that opportunity, would you? So before I begin, the most important disclaimer is anything I show here, any mutual fund or any security asset class that I mention here is not my recommendation. It's just for an example purpose. Please do your own due diligence and then invest. Do refer or consult an accredited, registered investment advisor before you put your money anywhere in the market. So the first point to analyze a mutual fund's performance is to compare the fund's performance returns with the benchmark. That is the first thing that any investor does when he picks up a fund. Eventually, after analyzing all the parameters that I discussed in the last video, then eventually once he narrows down to a particular fund, this is the first thing he does. He compares the returns of this fund for a long time to its benchmark performance. No matter what kind of mutual fund you're looking at, every scheme has a benchmark. Every scheme has a benchmark to work on, to compare with. A fund which consistently beats the benchmark over a very long period of time can be considered to be a good investment. But what's important is to find an appropriate benchmark which is not biased. Well, while tracking its performance against the benchmark, a small variation can be neglected. You can neglect if the fund has dipped for maybe a couple of years, then it has gone back up again. It is closely following the trends with the benchmark. You can still go with it, but not a huge difference or huge variation. That is not acceptable. Now let's take the same example of the small cap fund which we have used in the last video. Let's see how it has performed. If you see in the discrete returns column, it shows this fund, which is shown by the blue bars, has beaten the BSE 250 small cap TRI, shown in green, for all years since 2014. That's last 10 years at a stretch. Also, the data from the Nippon Mutual Fund website says this fund has beaten the benchmark by a handsome CAGR for a 3-year, 5-year, and since inception. That goes for a green card for this fund. But again, I am not recommending this to you. Number 2, compare the expense ratio of funds. We have discussed this in the last video as well. The more the expense ratio, the costly the fund is. These are the expenses for the fund house, the fund manager's salary, the AUM expenses, the charges for buying and selling the stocks. All these come in the expense ratio. As you see from the comparison table, the expense ratio of this fund is below 1%. That's 0.68. That's less. That's really, really less. Of course, there are funds that have lesser expense ratios, and we should choose the fund with a lesser expense ratio provided all other parameters are the same. So this is definitely an important factor to determine the fund's performance. However, it should be looked at in correlation, and other factors should also be considered in its place. One of those primary factors could be to find the effective CAGR of the fund, which we can get by subtracting the effective returns for the fund minus the expense ratio. You can see from the same comparison table, the effective returns for the quant small cap fund is way more than any other fund in this list. So this gives this particular fund an amber card in its class. It is good, but you need to keep an eye on it. Number 3, compare fund history. To conduct a mutual fund performance analysis, you need to scrutinize a long-term fund history for a particular fund. In other words, you need to identify how a fund performed in the past 5 or 10 years. Furthermore, you need to also check how these funds have performed during the bull and the bear phases in the market, and in all the bull and the bear phases in the market for the last 5 or 10 years. Those would give you good data points to validate a fund's performance. Now let's suppose you choose a fund which delivers more than substantial returns than the benchmark during normal market condition, but it dips down almost double or 3 times when the market falls. Now that is bad. That is really, really bad, isn't it? It might turn out so that you might conclude this fund is not a performing fund at all, because the dips pulls the fund so way down that the net average CAGR doesn't meet your expectations anymore. So let's see a comparison with the next best competitor to this fund from the comparison table. It looks like Quant Small Cap Fund has given good returns. We see from the comparison, Quant has given good returns only recently in the last 4 years, but did not meet the expectations as much prior to the last 4 years. From the graph comparison, the blue pillars, which refers to the fund performance, is far better for Nippon than for Quant for the last 10 years. Clearly, Nippon is a winner here, at least amongst this list, and deserves a green card. Number 4, compare the strength of the portfolio. By using ratios like the alpha and the beta, you can find out whether the fund has the potential to generate good returns with lower risk. The alpha ratio tells us how much this fund would give us a return over the normal benchmark returns for this fund. In contrast, beta would indicate how volatile this fund is. So for beta more than 1, fund record gains or loses more than the benchmark. For beta less than 1, a fund records gains or losses less than the benchmark. For a beta equal to 1, a fund would record gains or losses same as that of the benchmark. Now let's understand this with an example. With an example of 2 funds, A and B. Both the funds have the same beta but different alpha. From the numbers, we see since the risk is same for both the funds, the returns for fund B is more, hence it's better to go with fund B. The alpha and the beta values of a fund can be seen in the risk tab of the mutual fund in value research. We see for the example fund, the alpha is massive 9.22. With respect to that, relatively low beta of 0.8. Look at the Sharpe ratio. This measures the excess returns of a fund for every unit of risk it takes. Awesome numbers. For the data, it says this fund generates 84% more for every 1 unit of risk it takes. Let's look at the Sortino ratio. It tells us how well an investment protects its investors from downward risk. The higher it is versus peer, the better. Good numbers for this fund though, isn't it? The standard deviation for this fund is also high. Not very good numbers. But okay, well, it deserves to be considered. Okay, maybe somewhere between amber and green. Number 5, compare the portfolio turnover ratio. If your fund manager is frequently trading in securities, it can increase the expenses, the trading expenses. It increases the transactional charges. The expense ratio also increases. Thus, it negatively impacts your take-home returns. So just to conclude, on trying to decide which fund to choose, try and choose a fund which has a less turnover ratio. Number 6, knowing when a good fund can be bad. This is very, very important. When you're investing in a mutual fund, especially a stock fund, you plan to hold it for probably at least for 3 to 5 years, isn't it? So if that's an assumption, it doesn't make sense for you to look at the fund every now and then, at least until for the next 3 to 5 years. However, this is not to say that the short-term returns are not relevant. Returns for less than 1 or 2 years are not relevant. That's not the case though. In fact, a 1-year return, which is incredibly higher than its peers, can be a warning flag. Yes, a strong performance can be a negative indicator. The first factor could be, for an unusual year, all of a sudden a very high return can be suspected. It can be highly, highly abnormal. See, investing is a marathon, it's not a race. It should be boring. A very, very strong performance is not sustainable for a longer period of time. The second most important reason is this could be a problem because very short, high-performing funds could attract huge number of investors towards it. That becomes a problem because if you have a small AUM, you can place it anywhere on earth. But if all of a sudden there is a huge inflow and there is a huge jump in the AUM, it could become a big headache for the fund manager to manage that much money. More investors would mean more money to manage, and the fund manager will then have a bigger boat to navigate across the seas. So this particular fund, which had one of the greatest days in the last couple of years, would all of a suddenly see a huge inflow of money, and then probably, I'm not saying it will, but probably there are chances that the fund manager will not be able to manage it as effectively as he or she did in the last couple of years, and might find it very difficult to hold on to the good returns that it showed previously. Well, this and these videos here in this playlist will take you close, very, very close to select the best mutual funds for your investing journey, for your portfolio. Go ahead, click on it right now. As of this video, adios.